Looks like I'm live. Wow. Okay. Hi, everyone. We are having technical difficulties. So hopefully Nate Dodson, who's going to be doing the bulk of this presentation, will be logging on shortly. So in the meantime, there he is. Hey, I don't have to BS much longer. That's great. Because
my deepest apologies. You know what? If it weren't for tech issues, life would be nice and easy. So, still trying to get things all organized, but we made it. For the excitement of today, talking all about, hey, we're just going to go beginning to end of you're trying to raise capital for your business, for your fund, for your syndication, for whatever you are trying to accomplish with your entrepreneurial ventures and goals. And there's kind of a step-by-step process that you should be taking to make sure that you're doing it right. And I'm here, Nate Dodson, along with Richard Robinette, my partner of Crowdfunding Lawyers. And this is all that we do. Putting together deals with best practices to make sure that you're staying out of trouble, plus it's sellable opportunities. And let's start with step one. However, I still got to get this PowerPoint uploaded. So, Richard,
should we talk about the weather?
Yeah, I mean, we can just dance around for a little bit. It'll be great.
You know what? I will just throw in, like, today, December 4th, 2024, is an amazing day because yesterday, a federal court in Texas implemented a preliminary injunction on the Corporate Transparency Act. So all those LLCs and corporations and limited partnerships and other entities that were supposed to do a filing by the end of the year to disclose all of the personal information about their beneficial owners, that is now on hold. You do not have to do it until further notice. So it's not permanent. It's just preliminary. So we'll see, how it percolates up through the appellate courts. It might even reach the Supreme Court. Who knows? But for the time being, Corporate Transparency Act is out of our lives. And in my opinion, that's a really, really, really good thing because one, it's unconstitutional. Two, it's an undue burden on small businesses. And three, it's going to be completely ineffective. They think that by gathering all this data, somehow they're going to eliminate money laundering and financing of terrorism. And that's just ridiculous because, someone who's already facing 20, 30 years in prison for funding terrorism or whatever isn't worried about the penalties under the Corporate Transparency Act. They're just not going to do the filings. So the whole thing was silly. It was stupid. It was a waste of time and resources, and good riddance to bad rubbish. So excellent day.
Wonderful thing that we don't have to care about anymore, at least for the time being.
Yeah. I mean, it loses us some business, but I'm okay with that because this thing was BS. So,
Couldn't agree more. So just to kind of let's get this started with the good old forewarning. This is information. It's correct, but we're not your attorneys. You got to listen to your own advisors. We're happy to help, but this is all for your educational and planning purposes. Well, hire an attorney. We're here to keep you out of trouble.
Word.
I love it. So today we're just going to talk about getting the deal together and kind of the first steps of your getting out there and marketing and selling and what does it look like? What are you offering to investors? So that our main purpose, hey, we just want to go beginning to end, really clarify this. And like I said, we're going to go top to bottom. But really, Richard, I want to touch on that first item of asset identification in financial analysis. There are some weird quirks to financial analysis, and are you including it in a business plan or not, or pitch decks? Can it be misleading? I don't know. Can you talk a little bit about how you figure out an analysis and how you really, not how we figure it out, but how you use it?
Sure. So one of the important things when you're communicating with investors is that anything that you disclose is forward-looking. Here's what we think the numbers are going to be. That has to have some actual basis. You can't just pull numbers out of your butt. So when you have a syndication, for instance, when we've identified a property, let's say we're going to buy a piece of commercial property or a multifamily apartment complex or something, we will have a trailing 12 months financials called a T12. And so you can see this is how this property operates. It's got leases, it's got operations, whatever. And this, if we didn't change anything, this is what it did over the last 12 months. This is reasonably what it's expected to do over the next 12 months. Then we can say, okay, we've got our business plan. We're going to change this. We're going to upgrade so many units. We're going to, maybe the rents are under market. We're going to raise the rents. We're going to add this amenity or that amenity. And so that gives us a reasonable idea that we can increase the financials and we can do this. So here's what, we think in our pro forma is Latin for bullshit, but in our pro forma, here's how much we believe we'll make in the next year, the next 3 years, the next 5 years, and so on. And we're safe as long as we have a basis for giving those projections, and also disclaiming these are based on assumptions. Past performance does not equal future results. Things may change. Our assumptions may be wrong. Other things may happen. Disclose. But we've got a reasonable idea to say this is how this investment's going to do in 1 year, 5 years. Change that if we have a fund where we don't know the actual asset we're going to buy. We don't have a trailing 12 because we don't even know what property we're going to take down, or what. It doesn't have to be property, be any kind of investment, but we don't have that information. Then you really don't have a good basis for presenting a pro forma. You can say, well, we're going to target this or try to do that, but giving those investors a spreadsheet that says this is what you're likely to make, that likely is going to be deceptive because you don't have any foundation. You just made up a bunch of numbers and put them on a spreadsheet, and securities regulators aren't going to smile too happily on that.
If I could make just 2 really annoying comments. If you're doing a fund, you actually build your own target investment box, what you're choosing to invest into. And that box may be, I'm looking for anticipated returns of 10 to 15%. You don't really have the information about it. You're just kind of communicating. You're not going to invest unless you can hit these parameters. So that's one way to go about it. Mm-hmm. I do also want to bring up broker dealers just real quick. The broker dealers are the guys that go out there and can sell your investment for a commission. Nobody except for broker dealers and licensed registered representatives can take commissions. Their compliance is a little bit different because they have way more oversight from the SEC and the regulatory group called FINRA. They have a fair and balanced requirement to any projections, which basically means if you talk about the good, you got to bring up the bad. So a little bit different than doing an issuer direct type opportunity, but something to be aware of as you grow, as you scale, as you get other people to raise capital for you, so you don't have to do all the heavy lifting yourself. So that is kind of that front end. Richard, do you have any final comments on identifying assets in the financial analysis?
No, I said my piece.
Cool. Well, let's jump into the fun part, talking about developing an investment. So an investment, we'll call it a securities offering. They're really synonymous. Richard, I know you love to be an educator, so I'm going to sit back and twiddle my thumbs while you talk about both syndication and next fund structures of kind of what we see normally.
Sure. So what you're seeing on the screen is the most basic syndication setup, where you have an LLC. And LLCs can be member managed, which means everybody that owns the LLC gets a proportionate vote in what the LLC does, or they can be manager managed. And by manager managed, you can have a manager who may or may not also be a member. Member, by the way, just means owner. But the manager takes care of the day-to-day business decisions and really controls the entity, and the members simply own it. They're like stockholders. When you buy Coca-Cola, you don't get much say in what Coca-Cola does, right? They've got a CEO, they've got a president, they've got people making those decisions. That's like the manager. So here we have a manager-managed LLC, a manager on one side, members on the other side. The members just sit there like houseplants. They put their money in and they really don't do a whole lot else. Maybe there'll be some issues to vote on once in a while, but generally they're just throwing their money in the pool. On the other side, the manager, that's going to control stuff. Now, the manager is typically not a person. The manager in these syndications is typically a management entity, an LLC. And then that LLC is controlled by its own manager, who's really the person behind the deal or people behind the deal. We also call those people the sponsors, or some people call them lead investors, but they're really the ones that are driving the train here and making things happen. So a syndication is a securities offering. The reason it's a securities offering is because your members over here, your passive investors on the one side, are putting money into a common pool and expecting profits from someone else's efforts, the efforts being that of the sponsors or the manager who's really running the business. So Nate appears to have dropped off again. Again, technical difficulties.
No, I was just trying to make you look.
Oh, you're there. Oh, I thought you were.
Yeah, I'm watching.
I thought you'd abandoned us.
I would never do that. I know that you're actually so much better than I ever could be for educating people. You know what? I have nothing to add because you do such a good job of it. I just kind of make stuff up.
Yeah.
Here's the teacher, and not only the teacher, like literally used to teach people how to get into law school. This guy knows what he's talking about. Okay. So I'm going to drop off again to highlight you as you talk about, I think it's funds time.
Yeah. Hit me with the fun slide.
You've got it.
We didn't rehearse this.
Not at all.
There was that lady that commented so nasty the last time we did one of these and talked about how unprepared we were and stuff.
You know, we're here to have fun. That's about it.
All right. I'm having trouble reading your slides, so I'm going to see if I can blow up the screen a little bigger. There we go. All right. So here's our fund structure. And it's very similar setup where you've got investors on the one side and you've got the management on the other side that are controlling this fund. So again, the investors put their money in, they sit there like houseplants, and then you have managers or officers, some kind of title that's going to be controlling what the fund does. And then the big difference between a syndication and a fund is in the syndication, we know exactly what we're going to purchase. We know that this company is raising money to buy, the CVS at 123 Main Street or the apartment complex at 456 Oak Street, right? In a fund, we don't know. We may know criteria. We know, okay, this fund is going to target a certain class of assets in a certain geographic region of a certain size. So maybe we want Class B multifamily apartment complexes in Tulsa, Oklahoma, or in, Oklahoma, Arkansas, Louisiana, Texas, or something like that, right? But we don't know specifically what those are. So we are putting our trust in the fund manager to make those investment decisions for us on behalf of the fund and hopefully generate a return. So that's that structure. From a security standpoint, really not a whole lot of difference. There are a couple exemptions from registration where we may or may not be allowed to do a fund or certain types of funds, but in general, the securities rules apply equally. We are, taking your money and promising you, or hopefully, maybe not promising, but we are strongly implying that we will give you more money back after we've done some businessy thing over here. So,
and it is super important, if you are doing a fund, make sure you have a knowledgeable, experienced attorney, because there's actually other rules and regulations that are different from a business capitalization, or you're out there acquiring real estate or building real estate, what's called the Investment Company Act and the Investment Advisor Act. So there's just other laws. You do just try to find exemptions and the reasons why they don't actually apply. That's always the goal. Let's stay away from the restrictions.
Absolutely.
Again, you can get into a bad situation if you don't have that guidance and that support as you're moving forward. So just something to think about when you are, if you are putting together a fund, make sure you have an awesome attorney.
Put together any kind of investment, really. But yeah, there's a lot more to it once you get into funds, especially funds that are buying other securities. Then the regulation dumps on. That's when you
see. I got to be honest, though, at least in my experience so far, there's a lot of syndication attorneys that don't really understand the nuances of a fund or more of a registered or qualified investment that they actually go through the SEC.
Mm-hmm.
A lot of them just kind of stay, I do these syndications because I can plug in the information, hand it to my paralegal, they do it.
Mm-hmm. Do the simple Reg D just over and over and over.
Completely.
Yeah.
Definitely not what we do over at Crowdfunding Lawyers. We are always, you're dealing with the attorneys. We are pulling people out of Wall Street, people that have been attorneys that have been doing IPOs. We try to bring in the best. So little self-promotional. Hey, thank you. There you go. Next big thing. And I'm just going to actually make this super easy. Oh, by kicking Richard out. We need to talk about investment terms, what you're actually going to offer to investors and how you're going to say, okay, are you going to offer a preferred return, which is like an interest rate on the front end? Or are you going to offer a performance hurdle, which is like a prioritization of investors based on kind of the back end or what the asset sells for? So a simple example, I'm going to give you, Mr. Investor, 50% of the profits. But if you don't at least get a 9% annual return, I'm going to back off of my 50% just a little bit to make sure that you hit that number. I have a book. I created a book that has really deeper descriptions of all the different options, and you can see a little bit of the legalese. So check it out. Go to crowdfundinglawyers.net, ebook 1, and all the information is in there. So I definitely encourage you to download it and check it out. Always fun to go through that stuff.
More self-promotion. That's great.
Good times.
Right. Google's in progress for advertising or something.
Now we know what we're going to offer to the investors, an important part of the financial analysis. We know what we're going to buy. Now it's time to deal with the legal stuff. The fun and exciting, working with your attorney to do the entity, to do the documentation, the proper documentation, because it changes based on how you're marketing and what the regulations are. So different things to think about. Like, are you going to use a portal? Technology nowadays is one of the most important things that, I don't know, Richard, what percentage of our clients do you think, guess, are using investment portals for their opportunities?
Probably close to 100% now. It wasn't one of our clients. I reviewed a PPM the other day that still had like, send us this in the mail with your check or money order. But no, it's funny because when I started doing this, it was, PDF documents that were emailed out, sign the subscription agreement, email it back, wire the money or whatever. And it just within 6 months, there was a 6-month period, probably 2019-ish. All of a sudden, every client was on a portal. And now the offering documents are online. You just click and look at them. You click a button to invest. You put in your ACH information. It takes the money. Like, it's super ultra streamlined now. And that technology has really changed the game as far as communicating with investors and raising money. All your financial reports are on the portal. Your K1s are on the portal. Like, everything is right there at your fingertips. It's a really cool thing. And they can add, videos of the properties, and they can, have all kinds, Q&As, and it's really a neat development over what we had not very long ago. 5 years ago, nobody was doing this, and all of a sudden it was everywhere.
The market, the capitalization industry has changed a lot and continues to. I started representing as an attorney the securities mid-2000s. And at that point, broker-dealers were the norm. You're hiring a investment sales guy. They're underneath the broker-dealer. Broker-dealer's doing the marketing for you. They're doing the sales for you. The reason being, you weren't allowed to advertise, send your information online, driving traffic. You just simply weren't allowed to do that until the Jobs Act came around in, I think it was 2012. Mm-hmm. That opened up a brand new world of crowdfunding lawyers. You know what? I get asked this question so often. I want to hear, Richard, your answer. What is crowdfunding?
Crowdfunding is the most annoying term in the entire world. I absolutely hate it because it means so many things. So what most people think of crowdfunding, they think of Kickstarter, Indiegogo, which are like basically pre-sales of products. People think of GoFundMe, which is like donations for various causes. Someone's dying of cancer and they need money. You can do a GoFundMe, right? Those are all crowdfunding, but not the crowdfunding we're talking about. We're talking about regulated investment crowdfunding, which is basically raising investment money from the crowd, from everybody. And to make things even more confusing, there is an actual regulation crowdfunding, which is weird. Most regulations have like A, D, S, whatever, and then they made a word, regulation crowdfunding, for this one. So there's a specific regulation crowdfunding for raising money online. And then we talk about crowdfunding a bit more generically, where we also include Reg D and Reg A, where you can go out to the general public and raise money, and there's no necessarily requirement that you have a specific registered portal or anything like that, like under regulation crowdfunding. So in a nutshell, raising investment money from the crowd, from people, is what I call crowdfunding.
And that has really just become the norm of how to find investors. You don't have to hire the broker dealer. You don't have to pay their commissions. You can get out there and just start letting the world know what you're trying to accomplish and what you're raising capital for. There are different suitability investor requirements based on the rules. But at the end of the day, a big part of where we focus is on those opportunities that you can do these social media posts, the webinars, the email blasts. It just has opened up the opportunity to market way beyond where we were in the past. Mm-hmm. And Richard, you mentioned 2019, everybody starts moving to the portals. It really took off in 2020 to 2021. The rules started, but that's where they expanded the crowdfunding from the regulation CF. You used to only be able to raise $1 million. Now it's 5 million. It's way more functional. And there's even more benefits to it that we'll talk about in a second. But I'm going to, again, just hang back. And Richard can talk a little bit about offering documentation.
Oh, God, bane of my existence. So if you're an investor, if you join an investment club or an education group and people start pitching you deals, they're going to give you investment documents or the PPM, or private placement memorandum, is the most common one that you're going to see. And various Exemptions from regulation use different terms for their offering disclosure document. So Reg D, which is the classic private placement, uses a private placement memorandum. Reg A, I think it's called an offering circular. Reg CF, it's called the Form C. May also be called offering memorandum, if I'm remembering right, they use. So anyway, basically all just the same thing. It's going to be a big, thick document that's going to say, who's raising the money, how much are they raising, what are they going to use it for, who's behind it, and what's their experience, what's their past performance, what other things that they do, what qualifies them to be trusted with your money, right? And then usually at least a third of the document is going to be risk factors. And this is basically several attorneys sitting in a room and brainstorming all the ways the deal could possibly go wrong. So, you could lose your money this way. You could lose your money that way. A hurricane could take out the property, or, a new tax law could be passed that harms the property, or this regulation could, affect our profitability or our ability to sell products or lease to tenants or whatever the business is. And so it's just going to be like, whole list of these things. Don't say we didn't warn you, because we warned you every possible thing that could go wrong. And if anyone were to read those documents and take them seriously, they'd never invest at all, because it's so overwhelming how many ways things could go wrong. So that'll be like the disclosure document proper, the PPM or the Form C. And then you're going to have exhibits that are going to be, the governing documents of the company. So if it's
Before
an LLC.
we move on, can I just make one quick comment to the risk?
Your show, man.
It's our crowdfunding lawyers. But I do just want to mention, a lot of this document is risk factors. It is to warn the investors of how things may go wrong, but really it's a benefit to the issuer, to the sponsors, to the management. Reason being, as long as you did what you said you were going to do, if the investment doesn't work out as planned, as long as that risk factor is properly disclosed, then the investment just failed. There is not a claim that, you didn't tell us that another building may have been built or burnt down or whatever. You didn't tell us this stuff. If the risk factors are in there, you get to say, well, I warned you. I'm sorry for where it's at, but I still warned you. All right.
That out. As an issuer, that disclosure document is your first line of defense. And we actually had a client several years ago that got sued by an investor, claiming that he had made all these promises and all these claims with no basis, and on and on and on. And that ended up, after several years of litigation, ended up getting thrown out. And the reason it got thrown out is because everything was disclosed in that PPM to the investors, in that disclosure document to the investors. And so it really is, don't say we didn't warn you, because we warned you. And you, as an investor, should know what you're getting into because you've read the PPM, right? So, so after that PPM, what's going to be attached or with it, or if you're on a portal, most of these are on portals now, is going to be, another link on the page. You're going to have exhibits, which is going to be like the company agreement if it's an LLC, or the bylaws if it's a corporation. Or if maybe it's a debt offering, and so you'll have the actual notes and loan agreements that go with it. So, you can read about the company, how the company's governed, or how the investment's going to be handled, kind of the rules of the game. You're going to see business plan materials that we talked about earlier with the pro forma, or with trailing financial numbers, or with target numbers, something that, and that's the business plan really is kind of the sales piece, that you're hoping your investors will put more weight into than they do the risk factors, right? To see, here's the upside potential of this investment. Here's what we think we can do. And that's, they've gotten so so sophisticated now with people, professional photography and maps and market analysis and graphs and charts and all kinds of ways to show you why this is going to be the most amazing investment ever. So that would be in the business plan. And then you can have subscription documents, which are where you fill out, you say, I want to invest this much. Here's my, bank information for you to send me all my, ridiculous profits. And then there'll be a questionnaire about suitability. So one of the things that the pesky things with securities regulations is the people you sell securities to have to be qualified to invest in the securities. So depending on which regulatory scheme your attorney directs you into, you may be limited only to accredited investors, which means people with high income or high net worth. You may be limited only to a small number of unaccredited investors, or your unaccredited investors may be limited to how much they're allowed to invest in any particular deal. So there'll be a questionnaire to kind of help figure that out. Are you allowed to invest, and how much are you allowed to invest? And so all of that together is the offering package. And a lot of times we use the term like PPM to mean not just the PPM proper, but the PPM and all the exhibits and all the extra material. So yeah, that's the documentation. That's the stuff that we, as attorneys, prepare and advise on. Also, if you have trouble sleeping, it's a great cure for insomnia. So yeah, good stuff.
You brought something up that I think is really important for people to know, even without thinking about it. If you're raising money from investors meaning I'm going to give you money, but I just going to sit back and receive the profits, that's a security that you have to pay attention to these rules and laws. It doesn't matter if you are borrowing money from multiple people. It doesn't matter if you're giving equity or ownership in your company, whether it's a corporation or if it's an LLC. Or a little bit more recently, you can offer a safe agreement, which I hate because they're really not safe and it's misleading of the name just to start with.
Right.
But a safe agreement is basically like a option agreement that you have a contractual interest, but no actual ownership interest until something else happens in the future. And that maybe the company gets acquired or goes public or gets this valuation. The trigger can be almost anything. From the issuer side, from you doing the deal, safe agreements would be amazing to capitalize through them. However, they are much higher risk to the investors. And to the extent that they understand them, they also recognize that it is higher risk rather than just actually owning stock, owning interest in the company itself. So I just wanted to touch on that because it comes up. And thank you, Richard, for discussing it a little bit.
Yeah, no, I will, and I'll agree that SAFE is just an acronym. It means simple agreement for equity. It has nothing to do with it being a safe investment or any kind of secured investment or insured or anything like that. So it's anything but safe. That's just the acronym of the longer title of the document. So don't be fooled by the name there.
Well, thank you for the clarification. Yes, safe agreements are not safe, but they do. Yeah, whatever. All right. So we've got this PPM going. We've got the legal process going. And then, of course, the next fun and exciting component is creating an LLC. So generally, your attorney is doing this. You can save money and do it yourself. Filing an LLC is very simple. Structuring how the ownership and the management and the voting controls, that gets way more complex. So start with, it's generally a simple 1-2 page filing with the Secretary of State of whatever state you're trying to organize your company in. But if you're bringing in investors, you have to have what Richard was talking about, that operating agreement or company agreement for an LLC. There may be shareholder agreements with corporations. Again, just make sure that you're working with somebody that knows and understands how this really works.
Yeah. And I get calls all the time about, as someone who wants to form an LLC, and I'm saying, okay, great. Tell me about what you're going to do. Okay. It's going to look like this. It's going to work like this. Great. Here's the price. And they go, oh my God, why would I pay you so much money just to form an LLC? I can go to the Secretary of State's website and pay $100 or $300 or whatever the state's fee is. Why would I pay you all this extra money? Well, you're not paying us to file the LLC. That's the easy part. That takes 2 minutes. Who's the manager? What's the address? What's the name? Send, and you're done, right? What you're paying your attorney for is your operating agreement. It's to set up how the business actually runs. Because LLCs are kind of a blank slate. They're the choose your own adventure of business entities. They don't have these rigid rules and structure like corporations do. Or even like limited partnerships do. They really are, you can design them to do all kinds of things and work all kinds of ways. And you can make all kinds of arrangements with the other managers and the other members with how control works, how money flows, how disputes are resolved. And so that's really what you're paying your attorney to work out for you and to put, to memorialize. So if there ever is a dispute or a conflict, there's some clear rules as to how this business operates. If you don't mind, I'd give a war story of
that's
LLC that one of our two of our clients were involved in. So the scenario is this: they had a manager managed LLC, and the LLC had 3 members, 3 owners, one of whom was also the manager, and the manager was had contributed 60% of the equity to the LLC. So he owned 60% of the equity, which means he had a majority of the member interests, and he had management control, which means he was allowed to do all the day-to-day decisions. And then there were 2 other members, well, also family members. So like, this guy messy. So the 2 non-managing members were like, this guy is ruining the business. He's running it into the ground. He's not doing a good idea. How can we get rid of him? And I said, well, I don't know. Let me see your operating agreement or your company agreement. Same thing. And so they said, well, we don't have a company agreement. I said, okay. So what happens when you don't have a company agreement is the rules of your LLC are in the LLC Act in that state. So in this case, it was Texas. So I had to pull up the Texas LLC Act, Texas Business Organizations Code, and just see, okay, how does everything work? And it was really interesting because under the Texas LLC Act, voting is not done by your ownership interest. It's done by head count. So if you can fog a mirror, you get 1 vote, and every member of the LLC gets a vote. So because they didn't have an operating agreement that said voting is going to be by equity, that it's only going to be by head count, now the manager is outnumbered 2 to 1. And also under the Texas LLC Act, the manager could be removed for any reason at a meeting of the members where a majority votes to remove the manager. So they held a meeting, they took a vote, 2 to 1, he lost. He's no longer the manager. Now, he still gets to be the member. He still owns his 60%. He still gets his profits, but he no longer has any control over the day-to-day business of that LLC. And the other 2 members were able to install their own manager who would do what they want, and then write an operating agreement to make sure he can't be removed. So that's my war story. That's my my plug for please work with an attorney, get an operating agreement that runs your business the way you want it to run, not the way the state thinks it maybe ought to run.
You know what? I've got quite a few other war stories that are very similar to that. And every one of them has occurred because a litigation attorney was hired to set up a company. Litigation attorneys, they're there to go to court and fight. Transactional attorneys, we're there to make deals happen. Everybody has to get along at the end of the day to close a deal. That's where we come into play. But if you piss me off and I sue you, we're also not the guys that should be going to court for you. There's better bulldogs for that. And they're the guys that also don't know the transactional side, don't know what to include or what to consider when structuring and putting together your company. So, you know, we've covered some documentation, we've covered some setup. I do want to cover something that is really probably should have been the first thing. Can I raise capital or can I not raise capital? Comes up often. Exemptions from licensing. I talked about broker dealers. You license under a broker dealer, you can get a commission. You can, be out there selling everybody's deal. But there's some restrictions if you are the management and trying to bring in investors. So, Richard, do you want to roll with this, or would you like me to
Sure.
talk about licensing?
No, let's talk. So, the rule is, and this is in the Securities Exchange Act in 1934. It says that you cannot sell securities on behalf of someone else unless you are registered as a broker with the SEC. And becoming a broker with the SEC is not, unless you want that to be your primary business, those are not hoops you want to jump through. It's very, very difficult. There's testing, there's dues, there's FINRA crawling up your butt. Like it's all kinds of unpleasantness. So, as with pretty much all these regulations, we want to avoid registration. We want to avoid coming under the thumb of the regulators. So there is what's called the issuer exemption. And the issuer exemption says you can raise money on behalf of an entity if you're associated with that entity, as long as you check these boxes. And they give you a laundry list of things, including not being a broker-dealer, not being associated with a broker-dealer in the last 12 months, not receiving commission, having other duties, primary substantial duties other than raising money. So you can't just be the money raiser guy. You've got to be actually in the business with an actual role, and raising money needs to be incidental to that. And then one that people seem to ignore is you can only do one offering a year. And I tell this to people, I give talks or whatever to real estate groups, investment groups, and they go, "Oh my goodness, I did 4 deals last year and I raised money for them." What? So the exemption here is what's called a safe harbor, which means if you check every single one of these boxes, then slam dunk, home run, you are exempt. You do not have to register as a broker. That does not mean that simply because you don't check every last box that you do have to register as a broker. In other words, you lose the kind of automatic safe harbor, but you can still argue, hey, I'm not a broker. And so the 1 year thing, I think, is probably the least important of them, because what the SEC has said repeatedly is that compensation is the hallmark of brokering. So if you're taking money for raising money, you're going to have to register, right? If you're not, you've got a decent argument, especially if you check as many of those other boxes under the exemption as you can. You've got a decent argument that you're not brokering without a license. You're not breaking the law. So sorry for getting a little bit in the weeds there, but
you know what? I do want to just kind of bring up a third capital raiser. We've talked about you're in the management, you hit this issuer exemption. We've talked about broker dealers. Mm-hmm. They can receive that performance fee, that commission for raising capital. The third one is the registered investment advisors. They are very unique in that they aren't able to charge a commission for raising the capital, but they can charge to the investors fees to do their own underwriting, to do their own investment decisions or encouragements. And then there generally is an annual assets under management fee that gets charged to the clients. What we generally do when we're putting together a deal is we may create a separate class of interest just for the registered investment advisors that you're giving a little bit of a better return to. Reason being, well, the investors are also paying the investment advisors, so they need to have that higher return in order to make up for the costs of that investment advisor. So that's just the third strategy to be able to raise capital as well.
That's a good one.
Always a good time. All right, let's talk about, this is my funnest favorite part, marketing. And really, there's two big rules. The general solicitation, can you advertise? Or are you not allowed to advertise? And then we generally call this the friends and family round, where you aren't allowed to post online, to do the webinars, to do the seminars, but you sure can work with the people that you know. Marketing strategy for that friends and family is know as many people as possible. Go hang out at the Chamber of Commerce, at all of these investment meetups. The bigger your network, the easier it is to raise capital under the friends and family rules. But again, if you're raising capital, the regulations matter.
Yeah.
And just to have some comment?
Yeah, let me.
Of course, yeah.
The hairs on my neck sticking up. So, one clarification, I think an important clarification about this term friends and family. Friends and family is not literally friends and family. All right. So, what we need is a pre-existing substantive relationship with our investors if we're not allowed to advertise. In other words, we have a business relationship with them, or we have some kind of relationship with them where we understand their situation financially. We've got a good idea of their income and net worth. We've got a good idea of their sophistication. We know them in that way, not necessarily this is a guy I know because our kids have ballet together or something. So, there is technically no friends and family exemption in federal securities law. There isn't. Some provinces of Canada actually have a friends and family exemption where you can just sell securities to your buddies. When we say friends and family here, we're really talking about people that are in your professional network of investors, and not just your drinking buddies. Your drinking buddy probably isn't qualified to invest anyway. But none of my friends are all like, yeah.
Your drinking buddies may be your best investors.
Drinking tea buddies.
There you go. But so the regulation that we're talking about is this Regulation D, Rule 506B. You're allowed to have up to 35 sophisticated. They know what they're doing. They understand the investment. Non-accredited, not high net worth investors. Plus, you're allowed to have as many high net worth accredited investors as you'd like. Again, you're just not allowed to advertise it. But then there's these other regulations that I skipped over entirely.
Man.
Just flying all over the place.
Right.
But there are advertising allowed under other rules. The Regulation D 506C, you're allowed to work with as many accredited investors, but accredited investors only. Regulation CF, you can work with all investors, but you're capped at $5 million. And just to mention this, the big guy of these exempt investments, Regulation A, this allows you to raise money from everybody for up to $75 million. If you are advertising online, email blasts, or if you have a newsletter that is going out on a regular basis, that's a great time to showcase, to provide information about your opportunity. However, you don't really know everybody on your email list. They're not your known relations, fits that Reg D 506B, friends and family. I'm still going to call it friends and family. They don't meet that rule because you don't really know them. You haven't talked to them. you don't know their dog's name or whatever. Point being, you go play golf with somebody, you're spending hours with them, you get to know them. Well, then afterwards, go ahead and sell them an investment. They drop their name in a hat at that last networking conference that you went to. There's no relationship there. So important things to think about, but there are those other strategies that allow you to advertise and market everywhere. And that is, at the end of the day, the substance of crowdfunding is getting out there and reaching out to the crowd.
I'll tell you what, if I had a nickel for every time I gave someone a business card at an event and had an investment waiting for me in my inbox the next day, I'd have a pretty large bag of nickels.
Completely allowable as long as you're using one of these rules that allows you to advertise.
Yeah, they weren't.
And that is the norm. Here's the downside of doing that. You may lose your exemption. If there's a problem, an investigation, an audit, and the SEC or the state securities investment regulators say, you didn't really have a relationship here. So you don't only have to return that investor's money, you have to give all of the investors the opportunity to ask for their money back. Mm-hmm. Huge risk. Don't do it.
Well, and it's bad for everybody. It's not just the issuer. Oh gosh, I got to get back all this money. But like that money's been spent. Like that property's been bought, right? There is no bank account with $10 million from the raise in it anymore. And so the only way, like you can't give all that money back to the investors, right? You've just bankrupted the company. So even as a passive investor, you want to make sure that the issuers you're investing with are following all the rules, because if they are ordered to rescind all the investments, you've lost all your money. You're not getting that back. Like even though they're ordered to give it back, there's no money there. You're not getting it back. So both the issuers and the investors, it's in their best interest to make sure these deals are following the rules and using the exemptions properly, advertising properly, depending on what they're relying on. So talk to your attorney.
That's the name of the game at the end of the day. So we have touched on a lot of these regulations. I do want to mention that you can actually do multiple investment offerings at the same time. I love the strategy of doing a regulation crowdfunding with the regulation E506C. Just for my little explanation, now you could raise up to $5 million from the not accredited investors, the lower net worth investors, $5 million, but you can still raise as much money as you ever wanted or needed from the accredited investors. And you can run those both side by side at the exact same time. So if you have a great example and just recently worked with a cannabis company. Well, cannabis, AKA marijuana, it is more acceptable to the younger generation. Younger generation generally has a lower net worth. Doing these other exemptions really don't work for them. Now, if it's below $5 million, no problem. There's a solution. But some of these grow plants, or there's also technology companies that are focused on cannabis, they need much more money. And so that's where doing both at the same time really makes a lot of sense, with the reality of, hey, you're going to get a lot more traction with that regulation crowdfunding because you can accept everybody, but you can't hit your goal of $10 million or whatever it is with that. So just combine it, and now you can actually make it all happen. Other things to think about, but definitely talk to your attorney about it. It can get a little bit complicated in terms of compliance and making sure you're doing everything right. Always comes down to make sure you're doing it safe.
Killer.
All right, I love it. We do have just a couple of minutes. Entrepreneur guy, you are appreciated. Oh, he was talking to you, Richard. And,
always worth watching a video when he sees me. Thank you. Wow, I'm flattered.
Well, and that brings us to the most important part. Entrepreneur Guy, anytime you need an attorney, and this actually goes for absolutely everybody out there, you too, reach out to us. Richard Robinette, Richard at investmentlawyers.com, Nate at investmentlawyers.com. If you follow the QR code, you can just download the contact directly. But definitely want to give you all the power to make sure that you're doing everything right and are staying out of trouble.
Killer.
So, Richard, we just have a couple of minutes left. We've hit on so many different areas. Did we miss anything?
I'm sure.
All right. Well,
one of these days we'll need to go deeper into Investment Company Act, Investment Advisors Act, funds of funds, all that kind of stuff. Went down to Belize recently and did a talk with a real estate mastermind on funds of funds. And, had a really good time. It rained the whole time, but we had a really good time anyway. So
I'm still super jealous. If you didn't know this, between Richard and I, we spend a lot of time on the road. We love getting to know new people. We love educating. I don't know if he likes it. I love the presentation part, and I know Richard begrudgingly will do it. So really appreciate you.
I love the live presentations. It's harder to get me online, but because there's no one to laugh at my jokes. You know,
I'll laugh at you anytime.
Well, I mean, okay, but like a room full of people like laughing at my jokes. I mean, sometimes the jokes fall flat, I guess, but no. Yeah, I'm actually headed out to San Antonio tomorrow. I'll be speaking at a real estate education and mentoring group in San Antonio Friday, and then we've got another event next Saturday in Dallas with another real estate investing education group. So lots of travel coming up. I'm gonna go see Eddie Speed too.
Oh, you're ready to learn all about these debt investments.
Yeah. I'm gonna go hang out with him for a couple of days.
And Mr. Entrepreneur Guy, yeah, it was the first 15 minutes yesterday. We just had some tech issues. It was really a great discussion about seasonal businesses and younger entrepreneurial things to consider and things to focus on. I really appreciate the attempt to check us out. If you fast forward it, and what we're going to do is just re-edit it and then post it so we can capture as much as possible. Because I know you're one of quite a few people that checked it out, can't hear anything. I give up. It does work. We will get it up on YouTube.
Or just redo it.
We appreciate you coming visiting. All right. Well,
cool.
Appreciate you, Entrepreneur Guy. Richard, really appreciate you joining me as well. It is far too
be here.
We got to do it more often, whether you like it or not.
Once I get my better camera set up and figure out how to use that thing.
Yeah, well, you sound great. You look fantastic, and everybody knows you're a hippie anyways.
That's right.
All right, everybody. We appreciate you. Talk to you again.
Take care.